Hello and welcome to Shanghai Eye. Here on Dragon TV Monday through Friday, we'll bring you stories to decode and explore China. I'm Chen Xuan.
Hi there, I'm He Jian. We will look at business, tech, urban life, arts and culture, and sports, and everything going on here in the city. Recent months have been positive for China's equity market, with the Shanghai Composite Index surpassing the 4,000-point mark by the end of 2025. The global investment bank UBS expects the rally to continue, forecasting A-share profits to rise by 8% in 2026. Zhang Shixuan talked to James Wang, head of China Equity Strategy Research at UBS, to find out more.
If recent headlines about China's stock market surge have you curious, you are in the right place.
It's something that we've been hoping for, expecting to see, and it's really coming through.
An upward trend since September 2024, when China's stock market experienced its best day in 16 years after the launch of government stimulus package. Until now, the Shanghai Composite Index has hit 4,000 points, and the Shenzhen Component Index hit 14,000 points. This isn't just a simple bounce.
If you want to invest in the future, if you want to invest in innovation, the Chinese equity market is definitely a good way to play that.
Investment bank UBS predicts a 10% growth on China equities earnings per share in 2026.
We are positive, particularly in the first half.
As for the new hotspot emerged so far this year,
AI is still going to be a very big thing. There will be sector rotations.
Chinese AI firms and chip makers have started flocking onto the stock market.
AI is going to be the dominant thing still for global equities, and the best ways to play that is going to be through the US and China.
Will this wave of stock price rally continue in 2026, and how? I sat down with James Wang, head of China Equity Strategy Research at UBS. Mr. Wang, great to have you with us on Shanghai Eye.
Thank you.
UBS recently set a 2026 year-end target of 30,000 for Hang Seng Index and 100 for MSCI China. What do you think is the primary investment narrative supporting these targets, and what is the biggest risk to achieving them?
The way we think about a target is we think there's sort of 14-15% upside for the full year, and we get it a couple of ways. So we think there's going to be EPS growth of up to 10% for the full year, and maybe a bit of valuation uplifts to say 4 to 5%. If you look at the average valuation for Chinese equities, particularly MSCI China, for example, we're still trading around historical average. But versus global markets, MSCI Global or EM, we're still trading close to one standard deviation below historical average. So with US cutting interest rates most likely this year, we think there's still valuation upside for Chinese equity. The second part is on EPS. So we've got 10% EPS growth, and we break it down into a couple of parts. So we've got revenue growth of 5% for the full year, and that's broadly consistent with our nominal GDP growth of 4 to 5%. So it's consistent with what we've seen historically. And the second part is going to come from margin expansion. So we've got 4% margin expansion. One part of that we have seen, for example, depreciation peak out for listed companies. And what that represents is because CapEx for listed companies have been declining. So if I look at listed companies, since 2024, CapEx have been declining to the extent of up to 10% for listed companies. It's recovered a little bit, but still on a declining trend in 2025. So for this year, 26, that declining CapEx should result in lower depreciation. So that provides a bit of an EPS boost to the extent of 1 to 2 percentage points. And the second part to that margin expansion is going to come from anti-involution. So we have seen different sectors going through anti-involution, prices being increased for certain sectors, and we think that could contribute something like 2 to 3 percentage points to the EPS line. So that gives us earnings growth of 9%. And then on top of it, we've got 1% buyback, which is a current running yield for buyback for Chinese equities. So altogether, 10% EPS growth and valuation of 4 or 5%, giving us 15% upside for Chinese equities.
Your 2026 outlook also notes that favorable factors like AI advancement and policy support may continue, but their driving force could weaken. Does that imply a more selective and stock pickers market in the year ahead?
I do feel that long-term money are going into the AI sectors, but to be fair, the long-term money hasn't gone into Asian market just yet. And that also comes from my other point, is that offshore money, particularly long-only money, they haven't had the bandwidth. And so we do need the teams to build up, and then I think the foreign capitals will flow, the long-term money will come into some of these AI names. But I think the interest is there. But the question about monetizing AI, I think it's a global question, right? I think if you talk to US investors, global investors, the same question hangs over US AI names. Can the massive investment they're making, we're talking about 500 billion of US per annum into AI, can companies monetize off it? So I think it's a global question for everyone. But the one thing I would comment for China is that a lot of the investment in the US also had to do with the lack of infrastructure, energy shortage, data centers. Whereas for China, we'll have less of a problem.
How would you evaluate the mainland stock market performance since the start of 2026?
It's something that we've been hoping for, expecting to see, and it's really coming through. And we think there's going to be more coming through. Is retail participation, this animal spirit coming back in Chinese equities? Because let's face it, interest rates in China are very low. Retail deposits are generating only 1% return. Government bond yields 1.8, not even 2%. So I think the reason why a lot of retail investors haven't gone back into the equity market is they felt scared, they didn't feel like there's money making. But now we've had 2 years of consistent performance in the equity market. So I do think that money generation effect will encourage more retail investors to come back into the equity market, particularly on the A-share. Also, we should expect insurance companies with the new premium allocation from last year's premium sales, it should come through into the equity market. And then we also expect foreign institutional investors starting to allocate towards China, and that decision is usually made at the beginning of the year.
You've added exposure to going abroad concept stocks like some industrials and materials names. Is that a tactical bet on a global cyclical recovery, or it's a strategic shift towards Chinese firms with global competitiveness?
Last year we didn't have some of the going global names because we were worried about tariffs. But it turned out these companies, these going global companies, continue to be very resilient. These Chinese companies are doing well, not because they're cheap, because in innovation their products are good enough to compete globally. For us, I think it's a structural trend that's going to continue. Yes, there will be uncertainties around geopolitics and tariffs, but I think that structural trend is going to continue. And one thing what we've found is some of these companies with high overseas exposure is their revenue growth has consistently outperformed the broader market, right? And they're outperforming because their products are good enough and they are gaining share overseas. So I think that trend will continue. And also what we've observed recently, in 2025, their earnings growth have actually picked up. They've accelerated. Some momentums with these stocks, and that's why we've added these as one of our themes for this year.
UBS has constantly favored internet, hardware tech, and brokers. With valuations having risen, what do you think will be the next catalyst for these sectors, and where do you see the most durable earnings growth?
For now, I think we still very much like the hardware tech names. And within those, very much the semiconductor equipment names, because I think you will have sector rotations, but the big trend, the structural trend, is semiconductor localization, and we think that will continue over the next 2 to 3 years. And I think to us that trend is unstoppable. On the application side, we still like the internet giants in China because I think they are the ones that will most likely monetize off the large language models, the AI innovations. For internet, for example, we've had actually pretty tough competition within food delivery. So to the extent there is some softening in competition in the sector, I think that's helpful. Within brokers, for example, it's actually, I feel brokers are very undervalued for China. If I look at the earnings growth for the broker sector, they're about 70-80% growth last year. If I look at their valuation, they're still around historical average, right? Nowhere near the past peaks we have seen. So to me, it's a cost-effective way to get into this, beta rally or this, very strong rally bull market that we're seeing in the Chinese equity market.
Mr. Wang, thanks for joining us on Shanghai Eye.
Great, thank you.
We're now moving on to Shanghai A to Z. As the Chinese New Year approaches, signs of season begin to emerge across Shanghai. For many locals, preparing for Chinese New Year goes beyond purchasing food or gifts. And here are some popular choices of brands. Xinhualou has long been a fixture on Shanghai households' Chinese New Year shopping lists. Its 8-treasure rice pudding is a traditional finale to the Chinese New Year's Eve dinner, and its Cantonese-style sausages are equally popular. And Qiaojiashan is best known for its traditional pastries, with its craftsmanship recognized as part of Shanghai's intangible cultural heritage. As the Chinese New Year draws near, tangyuan or glutinous rice balls, along with other seasonal desserts, take center stage. As for where to shop, the Shanghai First Food Hall has been a must-visit destination for Chinese New Year provisions. And its curled meat counters featuring Cantonese sausages, Jinhua ham, and air-dried poultry, and particularly busy during the festive season. For many families, a visit here is less about comparison and more about tradition.
If you got any questions for us, you can find us on all the socials and all the content online as well.
We'd love to hear from you, and do join us here on Dragon TV Monday through Friday.
Thank you for watching. See you next time.
See ya.